Okay, so we're going to go ahead and get started. Welcome to Social Security. We're going to have another one of these in the fall and also kind of touch on Medicare as well. So tonight we're going to go over some of the ins and outs of Social Security, some of the things you may want to consider. And so hopefully we get you get a lot out of tonight's seminar. So I'm Dave Nieder with Bank of Charlestown in the investment division. And so welcome. And so we'll go ahead and get started here. Okay, so here is our obligatory, and in the smaller print as we can make it, all of our disclosures that we have. We have spent some time trying to become as well versed in Social Security as possible. Obviously, it's a big decision that you guys make as you approach retirement, and could be, you could collect millions of dollars. So it's a really, really important part of our overall retirement planning decision. And so that being said, we know enough to be dangerous with that, and we have a lot of resources with us that we have access to. But of course, we want to rely on the Social Security system. And of course, anytime we're talking about investments go up and down. They're not guaranteed, all that good stuff. So tomorrow, if you guys, I think you guys had all RSVP'd. So tomorrow we're going to send out a survey. We would appreciate some, if you guys get a chance, fill one of those out. That's helpful. If there's some other topics you guys would be interested in, we try and kind of hit on some key areas: Social Security, Medicare, college planning, estate planning. We're going to do a healthcare cost kind of in retirement, kind of a long-term care kind of a thing. So try and be very educational with that. Of course, you can go out to the website and find some more information there, and as well as follow us on social media. We would appreciate the likes and the social interaction that we have there. So this is the rest of our team. In the back, we have Evan Vink. He's here with us, one of our advisors. Lynn Neal is our client service associate. So you checked in with Lynn out there. We have Bruce Nieder, happens to be my son, so say very good things about him. So he just graduated, so he's going to be learning the craft here. Leslie, who's the head of our group, and then Ken Smith are the other folks that we have. These are some of the other things as we mentioned. So healthcare costs, we've got Medicare and estate planning things. Some we do in person and some via Zoom. So those are some of our upcoming things that we have coming out. And so we do send that out via email, I think social media and stuff like that. So if you would like to receive some of that stuff, just let us know. So Social Security was signed into law back in 1935 by Lyndon Johnson. So that was, it was kind of the first time that a safety net was put in place. So prior to that, you were pretty much all on your own. So, as the government was finding folks were retiring with no money saved, and so they instituted Social Security. Now, I mean, as you can imagine, back in the early 30s, probably a lot of the workforce was made up primarily male denominated or dominated folks. But, of course, that has changed, over time. So in 1939, so in 35, that was really primarily for the worker. And then in 1939, a spousal benefit came out. So currently, as it stands today, if you are a non-working spouse, you can receive up to 50% of the working spouse of their benefit. So if for the first time it brought into play retirement benefits or even for death purposes, it brought out a social net for the non-working spouse and even children. So course, very beneficial in that regard. So Social Security is one of those things that you cannot outlive. So, you probably hear that term pension, right? So Social Security, think of that as that really, it really is a source of a pension, right? Or a pension is a source of kind of Social Security. So it's the one benefit that you cannot outlive. So as long as you're alive, you'll continue to receive those benefits. We mentioned that, it could be in the millions of dollars that you could collect. Right now, the maximum benefit that you can collect per month is $3,600. So we're just assuming a $2,000 benefit. So you can imagine if it was a $4,000 benefit, you're going to collect probably close to $2 million. And I should say, if we're lucky enough to live that long, or maybe unlucky enough to live that long, depending on your scenario there. But truly a lifetime benefit that's a super, super important decision to be able to make. One of the things also with this is that it is an inflation adjusted number. So every year the Social Security system will announce what the increase, what the cost of living adjustment is. Everybody was all excited last year. I think it was close to 8.4% increase last year. They're talking about probably the benefit this year might be 3.6. So I don't know how they calculate it, but it feels like I'm spending way more than 3.6% per year on my stuff. But somehow that's what the government has come up with. So, collecting $2,000 today, if we look at that after just a 2% inflation rate, we're talking probably $3,600 in benefits 30 years into the future. So start out collecting $2,000. By the time I'm 95 years old, I'll be collecting $3,600 if it stays at that 2% inflation rate. So just keep in mind. So one of the things I would suggest is, as we go over these things, sometimes maybe instead of trying to focus in on the exact numbers, just try and get the concepts down of kind of what's there. So I know sometimes when I see math problems, and I haven't really worked them out myself and haven't let my brain kind of absorb them, sometimes my brain goes into kind of a jolt there, and I miss the general concept. So maybe instead of trying to do that math equation in your head, just get some of the general concepts down. So general concept is here, I'll make more every year through that cost of living adjustment. Some things will erode that. Of course, your Medicare, so for your healthcare costs, at age 65, you're eligible for health care. That also goes up with that cost of living adjustment as well. So unfortunately, it's a give and take. I get more in my Social Security, but they take a little bit more in my health care costs. I still probably net out a little bit better in benefits, but it is that give and take. So there are some definitions here that we just want to maybe kind of pick up on. So one of the first things to realize is that there is what they call a full retirement age. So what you see here is a chart. So depending on when you were born, it kind of dictates when you're going to be eligible to collect those benefits. Really, anybody from like 1957 and on is already at that point. So if you're 1958, you're just approaching 66. So really, we're talking about those folks born 1958 or older. And if you're born after 1960, your full retirement age is age 67. So that means that is the date in which you can collect, and kind of what the Social Security uses as the beginning point of some of the calculations that we're going to do. And so we'll kind of see some examples of that. So full retirement age. The next kind of important key concept is called your primary insurance amount. So your primary insurance amount is the benefit that you would collect at your full retirement age. So one of the things I would highly suggest that you do is you're able to go out to the Social Security website, and I would go in, create a profile, log in. I think you have to put your social and some other things, like any other website, right? And create a profile. A couple of things that's going to do for you is, one, you can print your benefit statement every year. So you can kind of keep track of that. Your benefit, that primary insurance amount is really based on a 35-year working history, your maximum working history. So you can check your benefit. You can check to make sure that they have your earnings correct in there. You can also run some hypotheticals inside of there. So what if I want to stop working at age 60 and maybe collect my benefits at age 62? What if I work a little bit longer? So you can do some of those calculations on that. So in this example here, that red arrow that you're seeing there is the primary insurance amount for this individual at 67, collecting 2,119. So a couple of things. If you collected early, there's a penalty. If you wait longer, there's a benefit, right? And you get more. There's an accrual. You get 8% more per year for kind of postponing that decision. A lot of times you hear folks kind of talk about this in years. So like 62, 63, but really it's any month. You can retire any month past age 62. So you could retire at 62 in 1 month, 62 in 3 months. So really, once you're past that, so, don't get those annual amounts, kind of stuck in your head. A lot of us kind of maybe work off of birthdays, or sometimes it's anniversary of how I worked or something like that. But really, anytime past age 62, you can begin collecting benefits. And obviously reduction starting early, more if you wait up to age 70. Your benefit stops growing at age 70. So that's the maximum that you could collect so at age 70 is the maximum amount that you can collect. Okay, so we talked about the reduction, right? So we start with your PIA, your primary insurance amount. And in this example, we're showing a person that's retiring that their full retirement age is age 66, right? But we know that some people are 67, right? So if I start collecting, if my retirement age is 66 and I collect at age 62, I have a 4-year reduction period, right? 66 minus 62 is a 4-year reduction period. We'll show you here, what if I'm 67? Well, now I've got a 5-year reduction period. So in this example, like I said, I don't know that I would get hung up on those exact figures, but essentially, collecting 4 years early, you'd have a 25% reduction in your benefit. Okay, and you can kind of see the chart. Of course, at full retirement age, we're collecting the full amount, right? So here's one at age 67, right? So that person had a 25% reduction. Because I'm collecting it 5 years earlier, my reduction is a full 30% reduction. So again, those of us that our age is past age 1960, right? So that's age 67. So, and then our full retirement age is listed there. So what are some of the reasons that we might not want to file before our full retirement age? So we'll go through some of those. So one is that's a permanent reduction. So if I collect at age 62, I took my 30% reduction, that continues for the rest of my life. So that's my starting point of where my benefits begin, right? So the other concern sometimes comes into play. A lot of people are like, well, I'd like to double dip. I want to work and I want to collect my Social Security benefits. Unfortunately, for every $2 you make over that $21,000 threshold, they're going to reduce your benefit by 1. So it's a 50% reduction. So let's say I make $2,000. So let's say I make roughly $23,000. A 50% reduction is I'm going to lose $1,000 of my benefit. So you don't have to make very much before it really kind of erodes away at that Social Security benefit. Now, as long as you're continuing to work, it's going to continue to raise that benefit, but to some degree, why would I trigger a benefit and then get nothing out of it, right? So, it's a pretty stiff penalty for doing that early. There's a couple of spousal strategies. We'll kind of talk about those, but So in some cases, your decision may end up affecting your spouse. So let's say my spouse is going to collect off of my benefit some point in the future. Let's say I pass away. Well, that early collection affects the spouse again. So that's my decision to take my reduction could end up affecting your spouse and could end up affecting some spousal strategies. So we kind of covered that. My surviving spouse, if I collected a lower benefit, if she's going to be eligible for my benefit, or if he's going to be eligible for her benefit, there's a possible reduction for that. So definitely something to keep in mind. Okay, so we talked about those penalties for taking it early. Here is the benefit of waiting. So this person, 66, is going to up to age 70. So that would be a 4-year increase, right, at 8% a year. This person could collect 132% of their benefits, or 32% more than what they could have potentially gotten. And again, you could wait to 66 in 6 months, or, it's just beyond that 66, your benefit will be higher and higher by that 8%. But it stops growing at age 70. So definitely, age 70, we definitely want to begin collecting those benefits. So if you're 67, that'd be a 24% increase, and substantially more. And one of the things we're going to show you guys is that, a lot of times, we've talked to, after being in the business for 30 some odd years, we've talked to a lot of people, seen a lot of people, collect their Social Security benefits. And I don't blame the thought process, but a lot of us I'm going to start collecting benefits as soon as I can so I can get something, because I know I'm going to pass away. Something's going to come and get me. But one of the things we would just have you guys take a look at, and we can run some of these projections for you, is, so we talked about that cost of living adjustment, right? So if I start growing my benefit at a much lower level, the impact of that has on my benefit when I'm 80, 85, maybe 90 is a dramatic difference. And we'll show you a case where it's upwards of $13,000 a year more. So when we look at that here, that it might be a $500 a month or maybe a $6,000 difference. By the time I'm 80 years old, that $6,000 difference has probably grown to $13,000 to $15,000, right? Just because of that compounding process up until that point. So, it's something definitely to plan. And one of the things that, as we kind of dived into this and looked at some different scenarios, I was kind of always under, but the thought process I had was, my wife and I are, we're approaching retirement. Heaven forbid I get a death sentence. I've got cancer that's going to kill me in the next 6 months. I always picture myself running out and collecting Social Security benefits as quick as I could just to get something. But if I'm the higher earning spouse, again, me triggering benefits early, maybe I only collected for 6 months and I affected my spouse for the rest of her life, while she lived. So in some cases it may be, and there's some different scenarios, we'll kind of go through that. But, just here's some of the differential, it could be upwards of a $200,000 difference. So just kind of showing you some of the math differences of waiting and kind of what that would mean. So definitely something to look at. So, and, again, I think our job as financial advisors is just give you guys something to think about, and then let you guys kind of make that decision for yourselves. So, as I've gotten older, I've had too many friends pass away, seen too many bad things happen. So, again, it's just, life is a fragile thing. And sometimes we do the best we can, with the decision we can make, at that time. So, as we said, it's a pretty complex decision. Kind of covered these things already. The earlier we start, the bigger the impact that has. And of course, we talked about the back end by waiting, that compounding effect by waiting just gets magnified, as we get older. So again, so when to apply, some of the things to think about besides COLA. We already talked about the decision that the impact may have on our surviving spouse. And again, just something to kind of work your way through as you and your spouse or significant other kind of make those choices. We should also probably cover here that under spousal, that same-sex couples are now eligible for spousal benefits, and so that's now been passed and come into play as well. So okay, so one of the things just to realize is that a spouse can possibly claim, and we'll look at some of those benefits. I think that was the first thing we hit on. So a spouse is eligible to claim on their other spouse. So a couple of definitions here. Entitled just means that that you're eligible for Social Security. So the other definition that we kind of want to talk about is eligible. So entitled and eligible. But basically what that means is that if one of the spouses, so let's just work through our example here. But so Jack and Jill are married. They're both at full retirement age, so no reduction, none of that. So Jack's primary insurance amount is $2,400. So Jill has never worked. And in order for Jill to get any benefits, we've got to wait for Jack to file his Social Security benefits. So if he waited all the way up until age 70, that means that would affect Jill in this case. So Jack's got to file for Social Security in order for the Jill to get the benefits. We already mentioned that the spouse is entitled to 50% of what the other spouse is making. So 50% of $2,400 is $1,200. So key thing is she's entitled to a benefit, but she's not eligible until Jack files. So there are some things like that, kind of these little kind of quirky things that we've got to work through. Now we talked about, so what happened if Jack had selected his benefit at age 62? We've talked about those reduction in benefits. And like I said, I don't know that I would focus on these per se, because one of the things I would recommend you do is definitely before you go to make any decision, I would say first thing is meet with your financial advisor. We can help kind of give you some things to think about. Second thing is go make an appointment with the Social Security office, and they will tell you all of your kind of benefits and the numbers that you would be eligible for. So they can give you those printouts so in our specific example here, so if Jack had filed for his benefits, instead of Jill getting 50% of those benefits, she's only going to get 35% of those benefits. So again, it affects not only Jack's benefit, but also the spousal benefits in those. And don't forget too, these slides, we'll send you these slides tomorrow. Definitely. And then, so we talked about one of the things, so the increase in benefits stops at age 70, but for the spouse, unfortunately, if Jack waited all the way until age 70, it's going to be 50% of his PIA, not the benefit that he starts collecting at age 70. So that PIA, unfortunately, kind of dictates if you have a spouse that's going to collect fully off of the other. We'll go over some other kind of projections. This kind of just shows that there's an equal weighting of both men and women in the workforce, where we started back in the early 40s and things. Only 28% of the workforce was women. So obviously there's a lot more women these days that have maybe as high or higher benefit than maybe the husband. And maybe she's going to be eligible to collect on her own benefit and doesn't even need that 50% benefit. In fact, if her benefit is greater than that 50% from her husband or spouse or whoever it may be, then she's going to collect, or he's going to collect on his or her own benefit. at that point. So in some cases, the spousal benefit, may not even come into play. So, as we mentioned, more and more folks are working off of their own record. So, all right. So as we mentioned, so we talked about entitled and then eligible. So here's some of the things that come into play, right? We said primary worker must have filed. The spouse must be at least age 62 for reduced benefit or full retirement age for 50% of the workers' PIA. So if there's an age gap, one person may have started collecting at age 62. If my spouse is younger than me, she would have to wait until she reaches that age 62. So if there's some age gap, there may be some things there that you folks may want to think about. And as we mentioned, it's not always the case. You can't always. So if you come in and you meet with Evan and he says, okay, what's your spousal benefit or what's it going to be? If you're going to work till age 70, the half might not be that actual benefit, right? It's working off of that PIA. And as we mentioned, no delayed credits for a spouse. And you have to be married for at least 1 year in order for that to become eligible for those spousal benefits. All right, so we're going to go through a couple of examples. So what if a spouse is entitled to the Social Security on their own benefit? So the spouse could receive based on his or her own benefit. And if the spousal benefit would be higher, the spouse would be paid that additional amount. We'll work through a couple of little examples here of how this would kind of play out. So we've got good old Jack and Jill here again. So they're married. Jack's at full retirement age. Jill is 62. So we've got Jack's PIA is 2,400. Jill's is 800. So, Jill's benefit right there, we see Jill has got, less than half, right? So she probably would be eligible for some form of spousal benefit. So Jack collects at age 67. So there's no reduction for Jack, right? He's going to collect on his own benefit. But Jill, she's going to have a reduction because she's going to collect at age 62, right? So Jill would get $500 based on her own benefit. And she's going to get 70% so that's the 70% of the 800, right? So we looked at one of those reductions. So that's her reduction for collecting early. And then the spousal is $260. So she's going to collect 820. So, half of 2,400 would be 12. So she's definitely below that threshold. So her collecting early affects, what she gets, not necessarily the older spouse that she has. And you kind of see the formula there. But like I said, I wouldn't get hung up on the formula. I would just, again, you collect prior to, even if it's a spousal benefit, you're going to get a reduction in benefit, kind of let the Social Security system let us calculate that. All right. So some strategies. So, if you think about it, there's really only kind of three things we can do. So if I'm married, both of us can collect early, right? So maybe we collect and take a little reduction. Maybe we're going to wait. So maybe we're going to work a little bit longer. So spouses claim later. So maybe both of us claim later. Or the other thing we could do is maybe one of us should claim early and then maybe one person can claim later. So really probably of anything, so there used to be some other special kind of things. There used to be a file and suspend. There used to be some other crazy things you could do. But unfortunately, there's really not a whole lot there. Those are kind of the three different scenarios. But so one of the things we're going to kind of show you guys is why would one spouse want to claim early? Well, so if Joe is 58, his PIA is 2,400, and he has a life expectancy of 85. Jane is 58, her PIA is 800, and she has a life expectancy of 95. So one of the things we can do is this is kind of one of the folks we use that helps with some Social Security planning But we can go in and put those scenarios in and kind of show you guys what the maximum benefit is that you guys could claim using kind of those different strategies that we have. But one of the things, let me throw out there that, and maybe before I move on. So let's say Joe collects his benefit at his PIA, right? So that's his full amount, 2,400. Let's say he passes away. One of the things a spouse is eligible for is that if my spouse's benefit is higher than mine and they pass, I can step into that benefit. So to some degree, as we talk about, why would Jane maybe want to collect a little bit early? Jane may want to collect early because if she passes, it has no impact on Joe, right? Because he's collecting on his own record and at a much, much higher rate. So in some cases, maybe Jane wants to collect early, even if she takes a little bit of a penalty. Why? Because sometimes males don't live quite as long as females, and it doesn't impact her in any way. So she feeds Joe a little bit of strychnine and he passes away, and all of a sudden she's got a much bigger benefit, right? So I think there was something just in the news on that, right? Some lady feeding her husband, I think it was fentanyl, right? Oh, Jesus, right? So, all right. So both claim at age 62. So, as we've already learned, right, Joe takes a penalty, Jane takes a penalty. So their PIAs and her benefit both affect those benefits, forever, till we're assuming Joe passes at 85, Jane's living to the ripe age of 95, but, and we can model that out. So if you said, okay, well, I think my life expectancy is going to be shorter, or maybe it's going to be average. So, those mortality tables, the kind of the theoretical law of large numbers, what's the average, life expectancy for a male and a female? Those have gotten a little bit higher, but maybe we want to assume, shorter. Maybe you have health issues and things like that. So we can model those things out for you. So Jane claims early, Joe claims later. Maybe that type of a strategy, right? So we've got some slides in here. These graphs don't really, I don't think they help very well, but I think this gives you a good idea of the claiming benefits, okay? So they both claim early, right? They both took a penalty, and you're obviously going to collect less over your time frame, right? Now, if Joe claims later and Jane claims early, it really has about the same impact as both wait to claim later, right? Because we had Joe passing at age 85. So for the last 10 years, Jane was collecting off of Joe's benefit and not the combined benefit, right? And she was collecting on a much, much higher level than both of them living for that time period. So these are some things that if that's helpful to you guys, and we would appreciate the referrals. If you guys have friends that are kind of dealing with this issue, we'd love to work with you guys both on an investment level, Social Security planning level, kind of that retirement. We'd be happy to run some of those strategies with you and help you guys kind of determine, what those benefits are. So one of the things that we had mentioned in there, right, we talked about the cost of living, the growth of those, and kind of what that could mean in retirement. This slide that you're looking at here, look at the dramatic impact. So what we're saying is the first year, so Joe passes, the first year that Jane goes to collect the income, look at that differential that the impact of starting early has on her first full year of income. So she would collect $23,000 of Social Security, as opposed to if Joe had waited, in some cases, maybe just a couple of years, 67 versus age 70, she would be able to collect $35,000 a year. So as you think of some of those people that that may be struggling later in life, why? Because it just seems like inflation kind of catches up with you. That back end benefit. So maybe delaying that collection point a little bit can be substantially more beneficial on the back end. So as we mentioned, we'd be happy to kind of run those scenarios. We've got the ability to do that. Logging in, collecting your PIA, checking on your benefit. And so maybe before I move on, because I don't think we get to that point, but or we don't delve into it, but some people think, well, back when I started, my first year that I was working, I was maybe making, $20,000 a year. Now I'm making $60,000 a year. Well, it is an inflation adjusted period, or you know what I mean? It's an inflation adjusted number. So 20 grand 35 years ago may be fairly similar maybe to what you're making now. So don't get frustrated with the fact that, oh man, I was only making, 15 grand and now, whatever your benefit is, but it is the highest 35 years. And so if you quit work for 5 years and then pick that back up again, it's going to be your 35 highest working years that's going to be out there. So, one of the things we've kind of found is that if there are years where you have a zero, I just literally didn't make anything that year. If that gets replaced with at least some earnings, it can have a bigger impact on your projection. But when you print that off, it is based on if you continue to work at your same rate for the same amount through your full retirement age. That's where that PIA projection has or comes from. So if you pull up a statement off the Social Security website, it assumes you keep working, at that level for that period of time. Okay, so let's kind of talk about some survivor benefits here, some kind of key things to kind of keep in mind is that the survivor benefits is based on really two things. So when did the deceased claim their benefit? So that's kind of called the original benefit. And then when did the widow or widower claim the survivor or the actual benefit? So kind of back to our Jack and Jill, the age differential, Jack's a little bit older, Jill's a little bit younger. So that collection, so when he may have started maybe at his full retirement age, he passes away at 68, 69, Jill's 63. When she goes to collect that benefit, could have an impact on what she receives. So just keep in mind that, age differential, there may be some things there, how do you know when somebody's going to pass? But, it's not always, oh, great, I'm going to step right into that full high amount. There could be some circumstances when that might not always be true. One of the other things to kind of realize too is that survivor benefit, if stops growing, at that full retirement age. So, waiting to claim it past age 67 doesn't help her, unfortunately, him or her in any way. So, at some point, at age 67 or whatever the full retirement age is, the benefit quits growing. So, couple of key points we'll run through here. So, of course, the benefits stop at each individual person's passing, right? So, and the surviving spouse is going to get the greater of either their benefit or the deceased. So whichever one is bigger is what they're going to be able to claim, and be able to claim that on the deceased spouse. So, so I think we covered all of those choices. Now, one of the things that kind of can come into play here that I don't think that is necessarily covered. Yeah, I think we do cover it, but let me just, and if we get to it, we'll skip it. But so a lot of folks will say, okay, well, I'm entitled to a widow's benefit, or I've been reading about a widow's benefit. So you can collect on a widow's benefit, which means I'm going to collect on my deceased benefit. Okay. Now, when you do that, remember we talked about by collecting early, I'm going to have a reduction in that benefit, right? So one of the things that we found is that if that deceased person has the higher benefit, maybe I don't want to take my widow's benefit at age 60. Maybe I want to wait until maybe I can collect on my own benefit. So that's one of the things that maybe we would want to consider is sometimes, even though I might not, or even though I might be eligible for it, I might not want to collect it. So in some cases, we've worked through it with clients and we've looked at the numbers. Start collecting maybe at age 62, collect off of your own benefit, wait until you're deceased or until you would be the full retirement age, maybe 67, and then collect on that much higher benefit for that longer period of time. But and or that widow's benefit, and maybe it's the opposite. Maybe that widow's benefit, maybe your benefit is much higher than the widow's benefit. Well, in that case, maybe you might want to collect on their benefit. Okay. So we kind of talked about, and we looked at the example, higher earning spouse delays their own benefit to age 70. Survivor spouse files for the survivor benefit at full retirement age or later. Claim maybe on their own benefit. So yeah, everything I just went through was on the next slide that we had to cover. So, but definitely at some point in time, there's a significant, you and your spouse are not going to pass at the same time, right? So just kind of work through those and kind of decide. It's highly unlikely. So at some point, somebody's benefit's going to stop, and just kind of think through those those potentials. So all right, so there's spousal divorced spouse benefits, right? So here's the rules on that. We just had a client a couple of weeks ago, was all worked up. He was afraid that it was going to affect their benefits. So first of all, let me say, if you are divorced, you can collect on the other's benefit if it's higher. Otherwise, it's going to be on your benefit. But you collecting on an X has no impact on their benefit. And in fact, they don't even have to know about it, that you're even collecting on. So here's some of the rules we've got to keep in mind. The marriage has to have lasted for at least 10 years. If you enjoy being married multiple times and you do that 3 times for 30 years, you would be able to try and collect on whoever had the highest one. So maybe the last one had the highest benefit. Johnny Carson, I think, is that famous example of somebody that was that case. He had 3 wives over the course of time. And I think, maybe even 4 of them, but I think 3 were entitled and 1 was not. So person receiving the divorced spouse benefit is currently unmarried, and the ex is at least age 62. And if the divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits, right? So we kind of talked about the entitled and eligible. So that does apply if you're recently divorced. It's got to be 2 years before, otherwise you got to wait. So there are some quirks there in those benefits. So if you get married, then your ex's benefits are going to stop, and you would want to begin collecting on your current spouse's benefits. So you of course got to show some proof of that. So the divorce decree and sometimes the old marriage certificate, you might have to bring some of those things. But again, you don't even have to notify your ex that you're going to begin that process of collecting on them. So some people are like, I don't want to talk to that dirtbag ever again. So you don't have to. So if you have an old Social Security statement or something like that, but you don't even need that. If you have like a date of birth or something like that, they can look up those benefits. But again, you don't even have to notify that ex of that you are collecting off of those benefits. So, but again, it would be the same. You would go through those same calculations of, is your benefit higher? Would I collect half of his? Would half of his boost mine a little bit? So you're going to go through those same calculations. So just because you're divorced doesn't necessarily mean that the calculations really are any different with that. The only thing you don't have to worry about is whether your ex is actually collecting or not. So So I guess maybe if he's not collecting Social Security benefits and you really want him to, you kick him to the curb and then you start collecting your benefits. But so that may be a strategy for you, tongue in cheek. All right. So marriage lasting for more than 10 years, surviving former spouse must be 60 or older. So this is kind of a little quirk, right? But so former spouse remarries at age 60 or older, they're still eligible to collect on survivor benefits. So, we've had cases where clients are 56, 57 years old. They meet somebody they're in love with. The decision to whether if I get married at 57 or 58 would impact the ability to collect on survivor benefits. So in some cases, we've had some folks happy as clams until they're after age 60. So just kind of one of those quirks in the system that, could impact you. And kind of as we talked about, surviving former spouse has no impact to which other survivors may be entitled. So kind of covered those things. Okay, so I think we kind of dived in, we went through the weeds a little bit on, the benefits, the reductions, some of the benefits of waiting, some of the quirks, some of the ins and outs of when you may or may not collect in some of those and kind of how those calculations. So, so we're just through our recent tax season. I know you guys all love your tax meeting with your accountant, but very common questions we get from clients is, I'm getting ready to retire. And a lot of clients, one of the first things that, usually one of the first questions we get is, well, I don't have to pay taxes after I retire, right? And unfortunately, just because you're retired doesn't give you a whole lot. There is a little bit of an addition to what's called the standard deduction for those 65 and older. But really, your taxation in retirement is almost no different than pre-retirement. Okay. The one benefit. So we will go through this. So the taxation of Social Security. So what are these? Why do we have this chart up here? Well, if I'm married, filing jointly, and my provisional income. Okay. So what is provisional income? Well, so down here we calculate our provisional income. One of the first things we do is we cut our Social Security in half. So let me just easy math here. Let's say I'm collecting $20,000 in Social Security. My first number that I look at is I take that Social Security and I cut it in half. So half of 20,000 is 10,000. Okay. Now I add all other income to it. So let's say I'm getting interest on the bank. So Bank of Charlestown's paying me a wonderful 5% CD. Evans Investment might be paying me 5%, maybe 4.5%. So I collect all of that income, right? That's all considered $5,000 from my IRA, right? That's a taxable, it's a potentially taxable event. So I take my Social Security, divide it in half, and then I add all my other taxable income to that. So let's just take an easy example and say, okay, I've got $5,000 in other taxable income. That's $15,000. As long as my provisional income is below $32,000, I pay no tax on my Social Security. So that whole $20,000, I don't even have to put on my tax return as taxable income. So, I mean, theoretically, if I start with my 10 and I want to stay below 32, I could collect $22,000 from a whole bunch of other places, wherever that may be, and I would still pay no tax on that 10 grand, right? So 10 minus 32 is 22,000. I've now collected $22,000. That's my new taxable income number. As a joint filer, I've got $26,000 of exemptions, deductions, right? So 22 minus 26, I don't have to pay any income tax. So I collected $22,000 from other sources. I collected $20,000 in Social Security. I have $42,000 of cash flow, and I paid no income tax on $42,000 of cash flow. So it's one of those things that is, so now let's say I go over the $32,000 threshold. So I made $32,001. All of a sudden, half of my Social Security becomes taxable. So again, my example, 10 grand, $22,001. So $32,001, all of a sudden I got to pay tax on $32,000. But again, I've got a $26,000 deduction. 26 minus 32 is like 6,000. Income at 10,000 and below, I pay a 10% tax on that. I paid $600. So it's not bad. You know, $600 on 32,000 of cash flow is still, as a rate, is very, very low, right? So it's one of those calculations. So the easy number is I may pay 0 on my Social Security. I may pay 50% of my Social Security may end up being taxable, or the most that you would pay on your Social Security is 85% of it. So 85% of $20,000 is what, like 17,000, something like that. Even though I'm an advisor and I do this every day, I have to use my calculator. But anyway, so the most taxable, you know, the most income that you would have to pay tax on in that Social Security is up to 85% of it. So, and I'm saying that as if it's a cliff, meaning, and I use kind of I use probably a bad example. So at $32,001, it's not as if 50% of, it's not all of the 50% of the Social Security comes into play. It might be somewhere in between. So maybe it might only be like 30% of your Social Security comes in, or so, but it's just the more and more you make above that threshold, the more and more Social Security comes into the taxable equation. So thing to keep in mind is just, you know, it is a calculation that we can run through for you guys and help you to begin to understand. But, you know, one of the key things is, yes, you do, I guess, get a little bit of a break in retirement in that, you know, 15% of your Social Security is never going to be taxable. So is there any benefit for retirement? Well, you do get a little bit of a break on Social Security with that. Depending on your state, right? Maybe some states don't tax the retirement income that you have coming in. So, you know, in some cases, you know, Pennsylvania, Maryland last year did some things. I forget on West Virginia. I don't have that in my head, but so is there really any way around that Social Security taxation? You know, unfortunately, at some point, and I would say most of us, we want more to live on than less, you know, so usually I'm not working on ways to reduce the amount of money I get to live on in retirement, right? More is better. But there may be some things, and in some cases, and I'll maybe use a pretty drastic example here, but you know, what if I've done a fabulous job and I've got $1 million in my IRA and I love sitting on my porch and rocking, and I don't go anywhere, and I'm happy as a clam living on my Social Security, and I don't need to take any money from my IRA. Well, at age 73, you've got to begin taking money out of that IRA, probably the tune of $50,000 or $60,000 a year. So lucky enough to have $1 million in your IRA, an RMD, required minimum distribution. It's a forced withdrawal that becomes taxable. So I may have been living and paying no tax on all of my income. All of a sudden, I'm 73 years old, and guess what? I had $50,000 or $60,000 of taxable income drop on my lap, and now I got to start paying tax on it. And it affects my Social Security taxation, right? Well, maybe I want to reduce that IRA between the time I'm 65 and I got to start going on it at age 73, right? So if I can take some withdrawals, maybe pay an effective tax rate of maybe 2 or 3 or 4% and avoid jumping to maybe a 22 or 24% bracket, you know, there may be some things we want to look at as far as that goes. But anyway, so those are some other things, you know, some possible things to kind of look at and plan around. But unfortunately, with taxes anymore, the government has given us very little wiggle room on what we don't have to pay tax on. You know, there's just, you know, I get to deduct my 401k, but I don't get to deduct the interest on my house anymore. most of us are taking standard deductions, and, in retirement, it's kind of difficult. It's just, if you can have lower expenses in retirement, get the house paid off, get all the kids out of the house, don't let grandkids move back in, don't let the neighbors move back in, whatever it may be. Whatever we can do to maybe reduce outflow, it allows you for maybe a little bit more maybe flexibility on income. But, as we said, we highly recommend you go through this exercise with your spouse, go through the planning, kind of figure out, work together on that. And if there's any way to kind of take advantage of some of those spousal rules, talk through some of those difficult scenarios. I know they're tough to do, easy to put off, but definitely work through those issues, because it is a benefit that it's going to be there for a long, long time. Definitely something to plan around. So any questions that we have? Yes.
I'm at 35 highest years.
Yeah.
Okay, well, I'll just straight up. At 59, I can retire from my job with full pension. I want to do so to move south and possibly work part-time or start my own business. Is that going to affect what my benefit amount will be later on in life?
Yeah, so good question. So you're kind of stumbling around, but possibly. And so, my suggestion would be is you can either through the website or through some planning, figure out whether that stopping work impacts the amount that you would be eligible for withdrawals. Because one of the things, so, if you go to pull up your Social Security statement right now, it assumes that you're going to work for, let's assume you're 59 right now. So it assumes that you're going to work probably through your age 67, right? So 8 more years. So if in those 8 years, and a lot of us, the last couple of years we're working, usually those are kind of like the highest years, you know what I mean? So it's kind of the most money I've usually ever made. But so if in those 8 years, there's some that would replace a 0, right? So I'm 59, if I quit now, I don't get those 8 more years, right? And so if those 8 years don't replace any of like a zeros or very, very low, then it probably doesn't impact you. And I don't know if that's making sense with you, but so we have, I guess maybe the easiest way to answer that is it really depends on what's in those 35 highest years. So if you're 59, it's going to look backwards for 35 years. And if those 35 years are some relatively decent years, it probably is not going to impact you in any way. But let's say in that 35 years, 10 of them, I didn't work at all. So I got 25 years where I worked and I got 10 that I didn't work at all. Well, the calculator is assuming that 9 of those 10 years got replaced with future earnings. You see where I'm going with that?
Yeah.
So a lot just depends on what's in those previous 35 years. And like I said, if you, if I was a stay-at-home dad and I didn't work until, I was 35, 36 years old, maybe 40. So I stayed home with the kids and, my spouse worked. And now I come into the workforce at age 40. And I'm now ready to retire after 19 years in the workforce, right? So I started in 40, worked till 59, I have 19 years. So my previous 35-year history, I got a big chunk of those years with no benefits in, right? So the computer says, all right, you're 59 years old, you're going to work 7 more years. The computer's assuming you've got some more years coming when you really don't. You're ready to retire at 59. So a lot just depends on what's in that previous 35 years. And that's where either the Social Security system or that you can go into that website and model. You can go in and say, okay, I'm going to retire at 60 or 59. And the computer then will give you an adjusted number for what your PIA would be. Okay. So, yeah. So we've had situations to where, yes, we've helped clients to kind of figure out what that number is. And we've had clients where it made a $20 difference in their full retirement. So he quit work at 59 and he didn't work another year, another day, collected his benefit at 66. It was a $20 increase in benefits from 59 to age 66. So it literally made no difference in his retirement benefit, whether he worked another day or not, because he had a packed full, full working schedule already by the time he got to 59. So if it's half full, you got some more work to do, you know what I mean? Or it's your benefit calculation probably wouldn't be as good. So, but very good question, because that's an important one. So, yeah. Other questions we have? Okay. All right. So, and if you guys have some kind of weird ones or some things we didn't necessarily touch on very much, but if you work for the government, there are some government positions where you waived out of Social Security. There's some of those calculations that sometimes get a little wonky, but we have a lot of access to resources. And so if you've got kind of a weird question, a wonky question, so first of all, Allie in our marketing department will be sending those slides out. So you have her contact information. And so if there's something you guys think about or you'd want to discuss separately, we'd definitely be happy to do that with you. And and also it's, if you have friends that are working through this and they would find that helpful, we are a very low pressure group. And so we're happy to help you and be of help to you. If that's of benefit, please, we'd love to help your friends and family as well. So with that, we are going to end our seminar, and I got to hit stop here.